Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now, joining us on the equity market bracket is someone with a definitive memo out, working with Ed Hyman at Evercore ISI, is Julian Emanuel. We're thrilled he could brief us this morning. How does the Hyman-Emanuel world look with a 1.7% growth rate? It's got to change.
It definitely does change. And there's no question about the fact that when you think about what's gone on the last 4 to 6 weeks, you're at one of these points where if you go back before the pandemic, we saw the soft data lead the hard data consistently for the decade before the pandemic. That has not been the case since 2020 consistently, but the questions are now open as to whether it is. And so, whether it's 1.7, 1.5, or maybe even 2 if things stabilize, the risks are clearly to the downside, and you have to account for that in different ways.
ISI are the kings of hard data. What's the hard data you guys see?
So the hard data is very mixed. Our team, the surveys team, led by my esteemed colleague Oscar Slaughterback, basically it's very mixed. There's and it's even more complicated by the fact that we've had a very poor weather winter, and actually this has been a very poor cold and flu season. So there's also that going on. And then, of course, when you think about the stress in the jobs market, it's primarily concentrated in that area in and around 1600 Pennsylvania Avenue. So very, very conflicting signals.
How did Fed Chairman Jay Powell do yesterday?
Amazing.
Why?
Knocking the cover off the ball. Because basically what he needed to do was project a sense of calm in an environment that is anything but calm. And he did, and he made the point. You can argue whether the word transitory was appropriate for the situation or not, but he went out of his way to make sure that got across. And if you look at the last trade war in 2018 and 2019, inflation was, in fact, transitory.
So where do we go from here? If you're an investor, you're stepping back, you're saying, I've had at the peak to trough, I had a 10% pullback in the marketplace. If I'm in the NASDAQ, maybe 12 or 13%. Is that a healthy pullback in an otherwise okay market? Or do we have something really else to worry about here?
Well, in our view, this is a pullback. Okay. But look, this is one of these times where the path of policy really is going to set the narrative in terms of whether the pullback has more to go, or whether we think you're actually starting a bottoming process, let alone the fact something more sinister. The market, to be clear, is pricing stagflation right now.
Julian Emanuel with us, Evercore ISI, a lengthy conversation to get us started this morning. Wendy Schiller on the Department of Education will be with us from Brown University. And then on foreign exchange, which was really sophisticated this morning, Audrey Child-Freeman, a strong hour here on YouTube. Subscribe to Bloomberg Podcasts out on YouTube. Okay, Julian, so I did a nominal GDP math, which I learned from Ed Hyman while the Fed, guidance came out. Mohamed El-Erian nailed it in a note later in the day out of Cambridge, where he said, okay, you got a growth dynamic, you got an inflation dynamic, and nominal GDP came in as a sum total a little bit, but pretty much level nominal GDP. Do you guys model out that we'll see a reduction in nominal GDP? And if we do, does that fold over into reduced revenues at the top line?
Well, in theory, it could. But from our point of view, when you think about the trajectory of both sales and earnings in corporate America right now, it's actually reasonably strong. And it goes back to the psychology of the last couple of years. So in essence, corporate America has actually been preparing itself for the conditions we see now.
Brilliant. Let me jump forward then. Can they cut costs fast enough? Can they adapt to maintain margins?
They have shown an ability
they
to
can
do
do
so, and there's
the kids don't see that.
And you bet against corporate America at your peril. You absolutely do. And from our point of view, the last couple years is the reason that the markets were able to survive the shock of the interest rate medicine that we got is because we were so prepared. And then there's this wonderful little tool that's going to backstop productivity. I know we're tired of talking about it, but AI is
they let AI into Ed Hyman's shop?
Yeah, I can't believe it.
Can't help it.
How do you do AI with a black Sharpie?
All right, so Julian, if the inflation impact from tariffs may be transitory to some degree, how about the hit to just overall economic growth? Is that a serious issue that economic growth forecasts need to be tempered a little bit?
Well, and you're seeing it, but again, what's important is the psychology around the jobs market. It is literally all about jobs, and we like to say that on balance, if you're the retail investing public, you don't necessarily have to sell your stocks while you've still got a job. And so, from our point of view, the way the jobs market unfolds is very, very important here. And, we're just going to have to see what the echo of the Doge layoffs is in the private sector.
So what are we doing with U.S. stocks here? I had late last year, early this year, I had everybody outside the U.S. rushing into the U.S. stock market. I'm hearing now some of the international buyers are leaving the stock market. What are we doing with this U.S. stock market?
So and no question, that's probably the biggest question we're getting, with international investors selling U.S. stocks. Our view is that even if you get a prolonged period of rest of world outperformance, this is not a zero-sum game. You look at the last period that happened. It's been so long ago, we can barely remember it. But in the OOs, all the boats floated. And frankly, again, this is why policy is so important. There could be a world where there is, very positive outcomes globally for policy. There may also be a world where that's not the case, which is why the markets and the economy and sentiment is on such an edge right now.
Tell us about the last paragraph of your claim note. You go in and, I know it's a look back, but you sum up the revenue dynamics, revenue misses, down the income statement, earnings dynamics, earnings misses. Do you believe, I don't know, I can go to the Bloomberg terminal, folks, and look up this statistic because Paul Sweeney taught me how to do it. There we go. JP Morgan, April 11th is when we get JP Morgan. What is that? That's 9 days after the world ends on April 2nd. Do you have any certainty about the uncertainty of your acclaimed last paragraph looking into the next earnings season?
Well, so this is going to be a season where what you're going to want, and it starts, as you pointed out, 9 days after, quote unquote, Liberation Day for tariffs. And so how is corporate America going to react to those 9 days and talk about the path forward? The issue here is, will we be able to chart a somewhat clearer path forward in terms of the commentary? It's less about what this quarter looks like, particularly for the financial companies, which, you're going to have mixed messages, great trading, slower banking. But it really is about the path forward and what the view is, whether this uncertainty will in fact begin to dissipate.
All right, so given that uncertainty, what are we doing right now? Am I buying stocks? Am I buying bonds? Am I buying alternatives? What are we doing here? Am I buying protection, maybe? I don't know.
No, we're not buying protection.
Okay.
That may change in front of April 2nd if the market were to stabilize and get a little bit complacent here. But I think when you look at this morning, this is really a process as opposed to an off to the races type environment or where you typically see volatility come in. We are gently accumulating. We're rebalancing based on the drawdown with the knowledge that the preconditions that end bull markets, with the biggest challenge of those being an impending recession, and we have to have faith. And there is, as an investor, you've got to have faith, period. But having faith that the course of policy and the resilience of the economy is enough for 2025 not to be a recessionary year, which we believe it to be.
Quickly here, at Evercore ISI, how do you go through the process of the recession call right now? Jobs. Okay. I agree. And they have 4.4% unemployment.
Right. And so the question is, when the unemployment report comes out the first week in April, are investors, is the psychology around that report going to be such that we can take a number that's below 100,000 but still positive? Okay. And what's the reverberation around that? And from our point of view, we think there will be a resilience built in at that point.
Julian Emanuel, thank you so much. Terrific summation brief there on economics of Evercore ISI and his equity market work as well.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Now on gold, hugely anticipated with the Gabelli Gold Fund. Chris Mancini with us, the portfolio manager for Gabelli Gold. Where do you model gold out? I mean, Chris, if you take a vector, you take the price of gold logarithmic y-axis, and you extrapolate out where we are, how brave are you to extrapolate out the price of gold?
That's a great question. I'm not that brave, Tom. I think that's the answer. After years in this industry, it's very, what is it? The, fortune favors the bold, but I'm not so sure it makes sense to be too bold. I mean, I think, but I do think that, it's not so brave to say that I think that gold's at least going to stay at this price here. It'll be at least where it is now by the end of the year. And I think that, maybe that is being bold, because I think that by and large, there are a lot of people, on the sell side who are saying that it's going to be lower by the end of the year.
I mean, I love his R squared. I think they have first of all, his R squared is lower than Mario Gabelli's. Yeah. But I think nobody in the world has an R squared is removed from the performance of the S&P 500 like Chris Mancini.
Yes.
Hey, Chris, on my screen, what I've got is the price of gold, and I look at it every day, and I quote it every day for our listeners and viewers here. How about the gold mining companies?
Yeah.
How do you think about them? How do they typically perform vis-a-vis the price of gold?
Yeah, well, that's the key, I think, is because what's happened is that over the past 5 years, what typically happens is that there's leverage involved in the gold miners relative to the price of gold, and that's because there's operating leverage, right? So it costs, say, right now, $1,500 an ounce to get an ounce of gold out of the ground.
Wow.
And when the price of gold was, it's right. So it's pretty expensive.
How has that changed over the years?
It's changed. Yeah, it's changed pretty significantly. So before COVID in 2019, it was around $1,000 an ounce. Okay. Now it's around $1,500 an ounce. And that's primarily because during COVID, it was extremely, extremely difficult to mine. Obviously you can't mine from home. And there were lots of restrictions in place and things like that, just social distancing, quarantining. Someone got sick, they had to quarantine everybody around them. The state of Western Australia essentially had a lockdown of the entire state, so you couldn't get people in and out of the state. And there is a lot of labor that works in the Western Australian mines that came from Eastern Australia, stuff like that. So the wages in Western Australia went up a lot, and all these little idiosyncratic things that happened all over, it really caused the price of gold, the cost to mine gold to go up so much. And then the costs have kind of stayed there. So we're still at this level where so what happened was that the price of gold was $1,500 the cost was $1,000. The price of gold went to $2,000 during COVID. The cost to mine went up to $1,500. So the miners didn't really do that well, whereas they normally should. And what's happened now, though, is that the price to mine is $1,500, but the cost went from $2,000 to $3,000. So we're seeing that the leverage now, but it hasn't been reflected in the miners.
Right. Help me with AEM, like one of your major holdings, Agnico. I guess it is a Canadian company, venerable. It's been around 60 years. Paul, it's not Apple Computer return, but I'm sorry. You look at it versus a major U.S. bank or a major consumer goods. I mean, basically, Chris, they're minting money, right? I mean, the total return is substantial.
That's very true. No. That's very true. I mean, that's why I said. I mean, we don't need to be that bold to predict that gold's going to stay at 3,000. But that prediction would mean that for Agnico Eagle, for example, at $3,000 an ounce, they'd be generating around an 8% free cash flow yield. So they're generating, and with some growth, so that free cash flow yield should grow over the next couple of years. And so these companies compared to banks, compared to tech companies, are generating, substantial free cash flow.
So, and folks, off the 2022 bottom, Agnico Eagle's only up 187%, 51% per year. Chris Mancini, 59% of your portfolio is Canadian. Tariffs, discuss it.
Yeah.
I mean, how do tariffs play in to moving a bar of gold over to Lisa Mateo's account in America?
Well, that's a good question. No tariffs on gold yet. I mean, but the good thing about gold really is that it's, such a large amount of value is in such a small amount of space because it is so dense, right? And it's so, meaning that theoretically, if there were tariffs on Canadian gold to come into the United States, the Canadians could send their gold to Switzerland on a, one plane load. Wouldn't be that big of a deal to send it to Switzerland, and then the Swiss could do it, could sell it in Germany or in, somewhere in Arabia or something like that. So it's not, it really shouldn't affect the miners too much, thankfully.
20 seconds. Is White Fang your favorite movie? The Klondike Gold Rush?
Yeah. Well, it's up there. I do like what's the other one? Klondike Strike, the Alaskan Gold, right? So they're all really good.
Don't be a stranger. Chris Mancini, thank you so much.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
At Morgan Stanley, she has the worst job. She has to tie in U.S. policy,
Good luck.
the cacophony of Washington right now, whatever your politics, into trying to hang on to your capital and maybe put it to work to make some form of return. Monica Greer is incredibly experienced with legit budget duties for the city of New York, and also a lot of good work in the House of Representatives. You know the halls of the House. You must be on the phone. What are the Republicans, and separately, what are the Democrats in the House telling you about the madness down there?
I think that everyone is just trying to get through this as quickly and smoothly as possible, at least from the budget perspective. They're essentially trying to take Doge and Elon Musk's recommendations and bake them into this new budget bill. One of the things that I try to remind folks is that while there's all of this market uncertainty around tariffs, cutting, and just general geopolitics, that by the end of the year, so if you're looking August to September, if we're thinking about federal fiscal year is what I'm talking about, there's likely to be some resolution and for the political sort of rhetoric to die down for a moment, because those tariff piece and the cuts are all going to have to be baked in, right? They're going to have to actually finalize them to vote on that bill.
I mean, the power of you and Michael Zizas at Morgan Stanley together is really a lot of academics. Do you see tariffs in any way moving the needle on revenue generation for the budget?
The very high end estimates is that they think they can get $1 trillion, around $1 trillion. 1.3 was the highest estimate I've seen. Realistically, it's seeing closer to maybe 700, 800 billion. But you have to take into account that they're also going to be tabulating existing tariff revenue in that. They're going to essentially be taking all tariff revenue, putting it through this external revenue service, right? A new sort of quasi agency that's going to funnel the money through the federal government to the Treasury versus just going straight to the Treasury, right? It creates a dynamic where now they can count it to the budget. So it's already existing revenues that the U.S. Treasury is already receiving, plus new. So we have to see exactly what that's going to be in total. So do the new tariffs actually move the needle that much? Not much.
Does the phrase shell game come to mind?
Not just the federal government in my mind.
She just lost me there completely.
But
Stay with us, folks.
But she knows what she's talking about. Monica, talk to us about kind of the budget, keeping the government running, the budget. I'm told, just give us the timeline. What should we be aware of here as investors? They're
going to have a final sort of blueprint by May. That's what we're expecting,
okay.
May.
And now we're March. Okay.
Right now we're in March. That you'll have an understanding of what are the top priorities. That doesn't mean that they're not going to change. They can change, as we all know, right until midnight before the bill is passed. So we're likely to get those final priorities in May, and then the Senate is really going to have to hammer out what they want this tax bill to look like. For us, when we're thinking through the cuts, the biggest risk to the economy is, do they go too far, especially on the labor piece? And we're already seeing some softening with the jobs numbers and with consumer data. And so how far does the federal government go? How does that impact not just federal labor, because federal labor only accounts for 1.9% of the labor force. It's how do the second derivative, the contractors, right, get impacted through all this change?
And what percentage of the labor force are contractors?
I'm not sure exactly that, because if you're thinking about it's not just contractors, it's also your grant recipients, nonprofits, universities. So it's a broader ecosystem.
Sure.
And so I don't have a direct estimate on that today. But when we're thinking through this, it's how deep do they go? And then do they actually, make good on the bet that then they can grow, spur growth in the second half of this Congress, meaning 2026, because Trump really has these 2 years to do business.
But at the Northern Illinois University, you were hunkered down there waiting to do your public policy career. Is there any history in the United States of America that budget cuts create growth?
That budget cuts create growth? I don't think so. That's from my understanding. Budget cuts do not create growth. Fiscal stimulus, right, creates that multiplier effect, right, for the economy.
Which we saw with 1, 2, and then the Biden stimulus.
Well, one of the things that you're trying to sort of balance here is that part one of this administration is that restructuring, downsizing, cutting, and part two of his legacy setting for Trump. So we're looking at the growth piece on this back end of this. So if you're looking at Trump 1.0 and the first time he was in office, he started with the stimulus piece and then followed with austerity. So we're in the reverse scenario now, and we just have to see if it's going to work out.
So when you're talking to your clients and they ask you about the Trump strategy of near-term pain in the economy for longer-term gain, do you tell your clients that's something you can bank on, or are you kind of dubious as to whether that can take place?
I would say more in the latter category, right, of making sure that we're being prudent about how we're positioning and the sectors and industries that we're looking at. So one of the things I found interesting through, not just assessing which sectors and industries are buffered from tariffs, is that they actually also align with many of the pro-growth deregulatory policies of Trump. So things like financials are likely to do well. You could see some activity on alternative energy in the United States. So not traditional energy, but alternative energy. Utilities, other defensive sectors have that buffer from tariffs. But when we're thinking about pro-growth, it's healthcare, financials, energy in that alt section.
But do you see pro-growth if Jerome Powell's modeling 1.7%? I mean, we're in a legit stagflation concern. I don't understand. I get Washington doesn't understand economics and finance. We all know that. But can they really establish a quote-unquote pro-growth strategy?
I think they can in 2026. So for us, you have to account for the tax cuts and deregulation coming to really fruition in that second year. This year, no. So from a tactical perspective, it's trying to find, when I'm highlighting those sectors, it's where we see an overlap with tariffs and growth policy, right? Tariff tariff insulation and the growth policy. So I think that that's an interesting place to look, and trying to essentially hedge on both of those issues.
Thank you so much. Monica Guerrero with us with Morgan Stanley on policy this morning.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Daniel Kurtz-Phelan had to take over the iconic Foreign Affairs, and everybody said, right. And he's at the ball. I mean, if you're up in Boston, it's that homer over the turnpike onto the roof of the Cask and Flagon. He is at the ball out of the park. The latest issue is on fire. It sits on my thing next. All of this, folks, it's like one or two expensive martinis to get the absolute best in international relations. For example, on their website, Foreign Affairs website, you can read Robert Lighthizer, who established Trump Trade One. You could read Gordon Hanson of Harvard, definitive on trade policy. And right next to it, and they both appeared on the show recently, Doug Irwin of Dartmouth was with us, The Incoherent Case for Tariffs. Daniel Kurtz-Phelan joins us now with his magnificent magazine. Daniel, you guys must be going 24/7 as well. What do Bone and Irwin say about what we're witnessing in Washington?
Well, thanks, Tom. Always appreciate the marketing. We should probably be integrating that martini line into some of our marketing copy. So I'll suggest that to our business side. It's a wild time in international politics and American politics, as you all know extremely well. You know, the Bone Irwin piece, what we asked them to do, these are two great economists, Doug Irwin, probably one of the greatest authorities on trade in the United States at this point. We asked them to really look at the different arguments and take them seriously, different arguments for tariffs. Bob Lighthizer, as you noted, has made, sophisticated cases for the use of tariffs and rethinking the trading system. You saw the Biden administration, frankly, take up some elements of that and run with it in ways that would have seemed surprising not very long ago. But what Bone and Irwin do is look at the different arguments you can make. Trump has, of course, talked about tariffs for a long time. He says it's the most, beautiful word in the English language. This has been one of his fixations for decades at this point. And what they say is that, look, tariffs can work for various ends. If you really want to foster domestic industry, if you want to use it for leverage over other countries, as we've seen in the last few weeks, all of that works. If you want to raise some revenue with it, that works. The problem is that Trump thinks you can do all of these things at the same time, and each one of them in some ways undercuts the other. So if you want to use, to take the example that we've seen recently, tariffs for leverage to get other countries to change their behavior, whether that's, Mexico sending troops to the border or Canada making at least sort of performative moves on fentanyl, although I'm not sure there's any real substance of that, then you're going to end up taking the tariffs off relatively quickly, and they don't have the other effects. If you leave them in place despite that, then other countries aren't going to see them as, reasonable incentives to change behavior. So
right.
you could kind of target them here, but trying to have them do all these things just becomes this incoherent mess with all the uncertainty for business and everything else.
So, Dan, we think about the discussion in tariffs, which has obviously ratcheted up dramatically over the last several months. Is globalism, which is a theme many of us grew up with in business, is globalism dead?
Well, it's certainly dead in the United States. I think what's really interesting right now is that you see much of the rest of the world continuing with something that looks, fairly familiar to those of us who would have been looking at some of these dynamics a decade or two ago. So you see, Europeans, for example, continuing to look at new kinds of trade relationships, both with each other and beyond. I think you'll see interesting dynamics between Europe and China, for example. Europe had made a pretty hard turn against China and sees real economic threat, but at a moment when it doesn't have a lot of options, I think you'll see more activity between Europe and the Chinese, or Europe and parts of the global South. And certainly in Asia, they're still very, very committed to something that looks a lot like, old school globalism. So I think what could happen is it'll become, in some ways more fractured. You won't have this sense of a true kind of global trading system, but you'll have lots of regional systems. And then you'll have parts of the world without the US that will continue to move forward. I think the administration thinks that we have the economic leverage, the economic might to avoid paying real costs for that. I think we'll see in time whether, the U.S. feels left out of something that is bringing benefits and bringing power to other countries, especially China.
And Dan, another hallmark of the Trump administration has been a greater sense of nationalism, maybe at the expense of globalism, and pulling back from some of the traditional relationships, whether it be NATO or just our support and how we view Europe, much less our trading partners, Canada and Mexico. Do you believe that would outlast the Trump administration in the sense that let's just focus on ourselves here?
Well, you do see it's not so much a turn inward, but a real interest in making deals with other strongmen. So you see Trump much more interested in this kind of great power diplomacy with Putin or with Xi Jinping or with, Narendra Modi or other kind of strong leaders that he sees as able to really do business with him, really make deals, while he's beating up on allies and really using leverage on allies. So that's, I think, a pretty different vision of the global system than we've seen in a long time. There are a couple great pieces in the issue that Tom mentioned that try to make sense of this.
Daniel, I could go all day about Foreign Affairs Magazine, but because of your expertise in China, I've got to ask. Folks, the book is The China Mission. It won every award of 2018. Daniel Kurtz-Phelan on George Marshall, dragged out of retirement. General Marshall, just shut up and go to China and fix it for us, which, of course, George Marshall attempted to do. How do we repair a China-U.S. relationship, or is it forever on a bipartisan basis fractured?
It's a great question, and it's been one of the really fascinating things to watch in the first couple of months of the Trump administration. It was really during Trump 1 that you saw that bipartisan consensus, that hard line on China start to form, and Trump was, of course, one of the big drivers of that. What we've seen in the past couple of months is signals that he may take a very, very different approach this time. And I think the Chinese government is really kind of waiting to see what that looks like and starting to develop options for what a kind of a real deal might look like. I think I'm skeptical that you could really get a kind of grand bargain between the U.S. and China that would wipe away all the really complicated issues, not just about trade and technology and fentanyl, but also about Taiwan and the South China Sea and all the potential crises in the relationship. So I think you saw in the last part of the Biden administration an attempt to at least create some stability in the relationship. Right. It's not a return to anything that we would have seen a while ago, but to at least prevent it from really going off the rails in ways that it seemed like it might for portions of the last few years.
I can't say enough, folks, about foreign affairs. A blistering essay by Mariana Mazzucato on where are we going with the globalization Paul Sweeney just spoke of. Daniel Kurtz-Phelan driving the ship for Foreign Affairs Magazine as our lead editor. Just can't say enough again about the need for subscription.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The newspaper's huge number of really interesting stories last night. Lisa, how'd you find 3 of them? What do you got here?
All right, so here we go, right? We were talking about filling out the bracket. I did it. I have Michigan winning, okay?
Oh, and the David Weston got to you.
Yes, because David Weston came to me yesterday.
See what happened.
And he said, I heard you talking about it. You have to go with Michigan. And I said,
it's not a bad call. It's not a bad call.
Okay, so if I win, I will take David Weston out to breakfast. Anyway, so we have some fun with it, right? But the Wall Street Journal has this story out today. Over the past 2 seasons, at least 7 Division I teams have been involved in unusual betting activity. So it's kind of like this other side. So it says some of the wagers involve people that are connected to that actual ongoing investigation into that gambling ring. Remember NBA's Jonte Porter, right? He got in a lot of trouble for that. So that investigation started with this look into Temple University. That started last month, and it's really spread into a lot of these other teams. But what it gets into is that the real problem behind it, too, are prop bets, because it allows bettors to wager on the individual player's performance. And so that's what's sparking
and Paul,
some of this,
I'm ignorant on this, Paul.
Yeah.
In the middle of the game, you can look at somebody and bet on their 3-point ability.
Yep. It's it's just amazing. And so I don't know how you police it. I can't imagine even thinking about policing that kind of stuff. But that's where we are, because it's right on your phone, Tom.
Yeah,
so
it is. So the
and kids are doing it too.
Yeah.
I've told you the story. I overheard a bunch of high school boys talking about betting not just betting like at a basic level, but like serious, detailed strategies for betting. I'm like, where did they learn that?
But it puts pressure on the players too, because the article was saying how the coaches are starting to hear from their players, like like some of their family members are pressuring them, like, hey, maybe miss a couple shots or maybe do this.
This is frightening. And Brian Eggers is the one on this, right?
Yes, he is. Bloomberg Intelligence. We'll get him on.
Go through March Madness. Next.
Okay, Tom, I have a new choice for you on your next trip to Paris. Okay.
Oh, nice.
Air France is launching a new first class.
That's what Tom needs.
They're trying to target those, wealthy tourists because the declining business customers, right? So these are customers who are willing to pay about, $12,000 for a flight from Paris to New York.
Excuse me, round trip.
Round trip. Okay. So it's investing big time, more than $1 billion a year for the next 5 years. For these suites, they're known as La Premiere, okay? Fancy champagne, caviar, star chefs. It's a suite. It has more space.
That's what Tom
6.5 feet long.
Yep.
Okay, you get the fancy sleepwear, the skincare products.
Oh,
on top
absolutely.
Of it. You have to go. Flights start this spring, so now you can start booking, Tom, for your next trip. Okay.
And what's interesting about this, and full disclosure, folks, I do fly Air France. I love them to death. But what's interesting about this is it's not business travel. This is people out there, and they're going. And my father used to call it cattle car. He goes, "We're not taking cattle car," and people will sacrifice to go business class, which is not 12,000 euros. I mean, it's shock. I don't know how they do it. It's like $3,300 round trip JFK to CDG. Business class. And that's a lot of money. I'm not downplaying it.
But it's worth it.
But,
especially when you're
it's a long flight.
Big fellow like Tom Keene.
Yeah.
No,
you're not going in some economy seat. Come on.
Mrs. Keene and Mrs. Keene and the kids fly in the back. And I fly business class. No, I don't. Lisa Mateo, thank you for that.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.